How would you like a monthly cash flow from a European ETF that delivers massive payouts? Since the end of 2025, one specific fund has been promising exactly that. We're talking about the globalx European Super-Dividend ETF. Super-Dividend. It sounds like a dream for income investors, right? What's interesting is that this ETF doesn't use covered calls or complex financial tricks to fake its yield. We're looking at a yield of around 8%, potentially even higher, and it all comes directly from real dividends. In this video, we're going to take a closer look at this fund. I'll give you my honest opinion and tell you if I'd buy this ETF for myself. But as always, this is not financial advice, just my own opinions and experiences. Let's stay on the globalx website for a moment to check the key facts. This ETF is a fresh arrival, having just launched in September 2025. It has already gathered 35 million euros in assets, not a massive amount yet, but a clear sign that the demand is there. Take a look at this chart showing the shares sold since day one. As you can see, investor interest has been climbing steadily. Now, let's fly through a few other important details. With an annual fee of 0.45%, this ETF isn't cheap, but it might still be acceptable for many investors. The fund is based in Ireland, uses physical replication, and is a straightforward passive ETF that tracks an index. All of that sounds solid so far. But here is the feature that really sets this ETF apart. It pays out dividends every single month. That's a huge plus for anyone focused on consistent cash flow. But we'll talk about dividends again later in more detail. However, you should keep in mind that this ETF is poorly diversified, with only 25 companies in the entire fund. To put it more positively, this fund is extremely focused. But focused on what exactly? Well, as the name Super-Dividend already suggests, everything here revolves around dividends. The ETF tracks the Solactive European Super-Dividend Index. The index documentation shows us exactly how these companies are selected. The Solactive European Super-Dividend Index seeks to provide exposure to securities from the European stock markets that exhibit high dividend yields while maintaining sufficient market capitalization and liquidity characteristics. The index will select and weight a fixed number of components based on their dividend yield, with a maximum weight cap of 5% per index component. In other words, this index aggressively filters for the highest possible yields, but only from large, established companies. I have to admit, I'm not a big fan of these selection criteria. This is where the danger lies. An extremely high yield is often a warning sign. You might unknowingly fall into a dividend trap. Companies where the yield looks high only because their stock price has crashed. If you're enjoying the video, a like and subscribe really helps the channel. Thanks. Before we dive deeper into the dividends, let's take a quick look at what's actually inside this ETF. Here is the country allocation. If you're expecting broad exposure to the entire European market, you might be surprised. The UK and Norway alone make up more than half of the entire fund. Major economies like Spain and Germany aren't included at all. There is, however, one positive aspect in all of this. You aren't just tied to the euro. You're also invested in British pounds, Norwegian kroner, and other currencies. In fact, the euro makes up only about 40% of the allocation. We see a similar concentration in the sector breakdown. Energy and financials together account for more than 60% of the total holdings. With a selection process based purely on dividend yield, that's not exactly shocking. Here are the top 10 holdings of the ETF. I have to admit, I barely know any of them. But one thing is obvious. Every one of these companies pays an extremely high dividend. Just for fun, let's check the yields of the top 3 holdings. The first one pays 10%. The second one also delivers 10%. And the third one? It pays around 10% as well. Let's be honest, numbers like these are absolutely insane. Individual stocks are one thing, but what about the yield of the ETF as a whole? Since the fund is still brand new, we don't have a long dividend history to look at yet. But if we check the dividend calendar, we can see 7 payouts so far, 3 of which happened this year. What I really like here is the stability of those payments. Since its launch, the ETF has consistently paid out 11 cents per month, no fluctuations at all. Of course, this could change in the future, but the track record so far looks promising. If we assume the upcoming payouts stay around 0.65% per month, we're looking at an expected yield of about 7.8% for 2026. That is a very solid figure. As we can see here, the dividend yield in 2025 was noticeably higher. That's simply because the price of the ETF has risen quite a bit recently. And since we're talking about that rising price, let's look at the actual performance. In this chart, we can see the ETF's performance since launch. The green area represents the price development, while the blue line shows the total return, which includes both price gains and dividends. What immediately stands out is that the price has skyrocketed since the start of 2026. For a defensive ETF like this, such a massive move is quite unusual. The main reason for this surge is the explosive performance of the energy sector lately. Take a look at this. This is the price trend of an ETF that only contains European energy companies. It's a massive move. Because the globalx European Super-Dividend ETF is heavily invested in energy as well, its price has surged alongside. The current economic and geopolitical situation has pushed commodity prices sharply higher, which in turn has boosted the share prices of energy suppliers. However, since this ETF was only launched at the end of 2025, its own history is too short to be truly meaningful. Fortunately, the underlying Solactive European Super-Dividend Index has been around much longer. In the index documentation, we can track the total return all the way back to 2014. This gives us a clear picture of how this ETF would have performed if it had existed back then. And in my opinion, this reveals the biggest drawback of this fund. For over 10 years, the performance essentially moved sideways. The only real breakout happened recently, in 2026. But let's take another look at that long period. Because this chart shows total return, dividends are included as well. This means that even though the companies in this fund pay massive dividends, the overall return over those many years was basically zero. In plain English, you would have received nice monthly payouts, but your invested capital would have slowly lost value, leaving your portfolio deep in the red. This reminds me a lot of the ETF's big brother, the globalx Super-Dividend ETF. That one has been on the market much longer, and here is its performance chart. The price is shown in red, and the total return in blue. No one knows what the future holds, but it wouldn't surprise me if the price starts moving sideways again, or even drops. If that happens, we could quickly see those dividend yields jump back up from 7.8% to 10 or even 12%. All right, let's wrap this up. With this ETF, we can expect very strong monthly dividends. Right now, the expected yield sits just under 8%. If the price drops in the near future, that yield could quickly jump to 10% or even higher. In my opinion, this fund is on the riskier side and should only be used as a small satellite position in a well-diversified portfolio. There are two main points that I find critical here. First, the diversification is very weak. The fund invests in only 25 companies, mainly from Norway and the UK. The sectors are also heavily concentrated in energy and financials. If the UK or Norway run into trouble, this ETF will feel it immediately. If the energy or financial sector struggles, we have the same problem. The second issue is the selection process, which is based purely on dividend yield. This almost automatically leads to companies with poor share price performance. And that usually means we should expect a very modest total return from the ETF overall. Its big brother, the globalx Super-Dividend ETF, has already shown us how this strategy tends to play out over the long term. Personally, I wouldn't buy this ETF because I prefer investing in quality companies and I care about a healthy total return. But that's just my view. Everyone should do what feels right for their own strategy. What do you think about this ETF? Write it down in the comments. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.